So Danielle, tell us, is this jobs report going to validate the bull or the bear case for the economy?
Well, look, there's a confluence of factors. There's a ton of evidence that we've seen come out in just the last week that suggests that the situation is not isolated to the manufacturing sector, where clearly there's still a need for skilled workers. We've seen about 5 reports this week. The first one that came out was Markets Services report. That came out in contraction, that employment index, and we said, well, that must be an aberration. Well, that was until we saw the ISM Services Employment Index come out yesterday morning at a 50.4 level, just above contraction. What we did at Quill Intelligence was we combined based on GDP weighting, services and manufacturing, and we found that employment in this country right now is at 49.9. Again, an aggregate of the two. So it looks like we're heading into contraction. There was a fresh CEO survey out yesterday, services CEOs, and they see the job market as being at the weakest point since 2009. So it's not just one report, Dom. We're seeing quite a bit of evidence that services is slowing quite aggressively right now.
So if that's the case, what is the trajectory for the U.S. economy? I mean, is it a situation where we could still be growing just more modestly, or are we due, because we haven't seen one in a decade, a deeper contraction?
Well, I think the game changer this week and what we found in our analysis is that for the past few months, we've been seeing certain indicators drop to the lowest level since 2015, 2016, which was an industrials recession that we went into, came out of, and the recovery kept chugging along. What we've seen this week, though, is that many indicators, especially some from the northeastern services sector, where the bulk of U.S. service workers work, in the Northeast, where you are, they have actually fallen to levels that go back to 2009 levels, which is recessionary. That's been the game changer for us this week, is that there's been a deepening in the weakness we've seen coming out of the employment services data.
So Danielle, we know that you are a more outspoken critic of the Fed. You've written a book about them. I wonder whether or not in this kind of environment, we are still focused so intently on the Fed, what it can do, what's in its toolbox, whether or not its ammunition has the same efficacy it used to. So take us through that. Are rate cuts a solution that can work to help keep this economy going?
Well, look, Dom, we've seen, 5 different reports over the last few weeks that shed light on what a 100 basis point decline in mortgage rates can do. We've seen major upside, whether it's housing starts or purchase applications for mortgages, existing homes, new home sales. So we know that interest rate sensitive sectors such as housing are benefiting. But other than that, if you query any company in America right now, they're not going to say that they're constricted by the cost of borrowing. So lowering rates even more from this level, and I think Jay Powell's very aware of this, it's only going to have limited efficacy, to use your word. See, I had to use your big word, Dom. Got me tripped up.
I gotcha. All right, Danielle, before we let you go, the biggest key for you in this jobs report coming up.
Dom, we've had 5 straight months of negative revisions. One of the first things that I was taught at the Fed was 3 consecutive months of negative revisions signals an inflection point in the cycle. We've had 5. I'm looking for 6 this morning. This is not a trend. This is a fact at this point.